Good morning, students. Welcome back to the session on advanced accounting. So today we are going to continue with our discussion on AS20. In the last session, we were discussing about certain principles of computation of EPS. We discussed about computation of EPS wherein a couple of components are involved. First was about the net profit or loss which is attributable to the equity shareholders. Remember the numerator? And the second component was about the denominator, wherein we were required to compute weighted average number of shares. Yeah. Now, in relation to this denominator, we could see there were a lot of adjustments. We discussed how this weighted average is computed, wherein the time weight is assigned in respect of the number of shares so that we get this weighted average throughout the period. Secondly, there would also be certain situations in respect of issue of shares. For example, bonus issue. Bonus issue was the scenario wherein the shares are issued free of cost. Therein we understood that weighted average gets impacted not only for the current year, but also for the comparative year, wherein the EPS for the comparative year is required to be adjusted. Correct? Now, similar to that, we will be discussing about the adjustments in relation to the right issue. I gave you homework that all of you should go through the concept of right issue. Yeah, because I'm sure you would have already read this earlier. So can you quickly now start sharing your understanding of right issue? What do you understand by right issue? Okay, can you start sharing your understanding of right issue quickly? Quickly. What do you mean by right issue? Quickly, what do you mean by right issue? Yes, over to you. Whatever you have understood or whatever you knew and you have read, please let me know. And I'm sure that the adjustments in relation to bonus weighted average must have revised up, because that is very, very important for the purpose of further understanding of the concepts related to right issue and the other one that we are going to discuss today. Yes, quickly. Over to you. So what do you mean by right issue? Yes, I'm waiting for your response now. Okay, great. Sanjay is saying a right but no obligation to buy existing shares of the company. That's correct. And other than this, if you are also aware of the features of the right issue, that will be helpful. So the point here specified is absolutely correct. Anything more that anyone else would like to do? Okay, great. So Gilbert is saying when shares are issued to existing shareholders at lower price, that means lower than the market value. Kamal is saying the right issue is made on proportionate basis, and the right is given to the existing shareholders to purchase the shares, and if they do not want, they can renounce the right issue. It's generally lower than the market price. That's absolutely correct. So now, let's try to understand about the right issue. Now, how does this impact us? This is what we need to understand. Right issue means issue by the company to existing shareholders. Whenever right issue is given, this goes out to the existing shareholders first. I can see a lot of responses now from Sanjay Sanjay, Priya, Rama, Prajwala, Sakshi, Nakul, Priyanka, Sushil. Very good. And whatever you have specified is absolutely on the lines that we are discussing now. So one, this goes out to the existing shareholders. Second, the right issue means the issue will be made at value below the market price. So let's suppose if currently the market price per share is 100, then the right issue price per share will definitely be lower than this. It may be 80, 90, 60, 40, whatever it is. It has to be lower than the market price. Okay, yeah. Now, because the right issue is made below the market price, so let's try to understand. Right issue, can we not say has actually got two components? So let's suppose 2 shares have been issued to existing shareholders. I'm saying to every shareholder 2 shares have been issued. Yeah, market price is rupees 100, but the 2 shares have been issued at rupees 50. Say at the rate rupees 50. Now, when 2 shares have been issued, so can we not say that 1 share has been issued at the rate of rupees 100 and the other one has been issued at the rate of rupees 100? Can we not say it like this? Absolutely yes. It will be not incorrect if we make this statement that actually the right issue has got 2 components. One component will comprise of the market price and the second component will be free of cost. Correct. And what does this reflect? This reflects nothing but the bonus issue. Same thing happens in case of bonus issue, but the only problem is that now when we are talking about right issue, we understand that there is some element of bonus issue involved in this. There is some element of bonus issue involved in this. But what is that element? Means what is the proportion of bonus issue in this? We don't know. We don't know. Because if we knew about the proportion of bonus issue involved in this, then it would have been very easy for us. Why? Because then we would make the same adjustment as we do in case of bonus issue while computing the weighted average number of shares. But here we have a problem. What's the problem? Problem is we are not aware of that proportion, because only that proportionate adjustment will now be required to be made whenever we make the computation of weighted average number of shares. Yes or no? Yeah. So that's why we now need to get onto that proportion. Understood the requirement to compute a proportion under this right issue? Yeah. So now there's a requirement to compute a proportion which will then be used for computing the weighted average number of shares. Yeah. So therefore, now as a next step, what do we need to do? Now we need to get on to that point. Now, if you look at your study material, there's a formula which is given for computation of that proportion. Okay, a formula is given for computation of that proportion. What's the formula? Fair value per share immediately prior to exercise of rights divided by theoretical X right fair value per share. So let me just put down this formula. Fair value per share immediately before exercise of right divided by theoretical X right price. What is this X right price? X right fair value per share. Appears to be a very complex formula, and anyways it appears as if we'll have to mug up something. So let's try to understand this concept, that what is required to be done over here. Okay, so let's suppose, as we discussed, there were 1,000 shares. What was the number of shares? 1,000. And before exercise of right, means before right issue, its market price was 100. Its market price was 100. So what will be the amount? It will be 1 lakh. Correct? It will be 1 lakh. Yeah. Let's suppose the right issue has come, and in the right issue 100 shares were issued at the rate of rupees 60 per share. At the rate of rupees 60 per share. Now what will be the value? What will be the value? It will be 6,000. Yeah. So after right issue, what is going to be the total number of shares? 11. And total value will be 1,06,000. Now in this case, if we have to look at this formula, do we know what was the fair value per share immediately before exercise of right? Of course, it's known to us. It's so simple. It's 100. So what is this? 100. And what do we mean by this theoretical X right fair value per share? Very simple. This total value that we get, 1,06,000 divided by 1,100. Can you tell me what will be the amount? 1,06,000 divided by 1,100. Can you tell me what will be the amount? Quickly. What will be the amount? 1,06,000 divided by 1,100. Yes, over to you. It's 96.36. This is what I could compute. But let me just say this was approximately 96. Yeah. Okay, Kamal has computed this. Kamal is saying 96.4. Now, this 96.4 or 36 is nothing but the theoretical X right fair value per share. So we'll just put it over here. And this becomes the proportion. What do you mean by proportion? This becomes the ratio using which adjustment of right issue in relation to computation of weighted average number of shares will be made, similar to what we used to do in case of right bonus issue. In case of bonus issue, 100% was considered from the beginning while computing the weighted average. Now while computing the weighted average, this much proportion instead of 100%, this much percent you will consider while computing the weighted average number of shares. And I could see a lot of responses again, very good. Huh? So I think you have been able to compute it very fast. Sakshi, Gilbert, Samarth, Manish, Pulu, Namrata, they have all computed this. Okay, Khushi and Anushka have also computed. Great. So now tell me quickly, have you understood this concept? Though definitely this won't be very much clear to you because you may still have questions around its computation. But if you've largely understood, then we can move on to one illustration wherein we'll apply the same concept and which should give us some more clarity. So I'm moving on to illustration number 4. Okay. We'll apply the same concept which will give us some clarity as around the same concept. Okay. Khushi and Anushka have understood. Sakshi is also clear. Very good. So let's move on to this illustration. Net profit for the year X1 was 11 lakh. For X2 was 15 lakh. So we are given 2 years, 2000 X1, 2000 X2. So net profit in 2 years is 15 lakh and 11 lakh. Number of shares outstanding prior to right issue. Oh, there's a right issue. 5 lakh shares. Right issue price was 15. The last date to exercise right is 1st March X2. Right issue is 1 new share for every 5 outstanding. So how many right shares have been issued? 1 lakh. Fair value of 1 equity share immediately prior to exercise of right means 1st March X2 was 21 and right issue price was 15. Now you are required to compute the earning per share. Can we do this? Tell me. Can we do this? Correct? Okay, so first of all, what do we need to do? First of all, we need to compute the theoretical X right fair value per share. Khushi has already computed the proportion. Very good. So now theoretical X right fair value per share. Theoretical X right. I'm not writing everything. So now what do we need for this? In the numerator, we'll need value. So what's the value before right? 21 into 5 lakh. How many number of shares were there? 5 lakh. Prior to right. Into 21. Plus. And in the denominator, we'll write 5 lakh shares. So these were the number of shares before exercise of right. Now, how many shares have come through right issue? 1 lakh. Plus 1 lakh in the denominator. Plus 1 lakh into right issue price was 15. 15. Correct? So what do we get? Can you compute this? Gilbert has computed this, Manish has computed this. Great. This comes out to rupees 20. Yeah. So now what's the adjustment factor or the proportion? Now study uses the term adjustment factor. That will be fair value immediately before exercise of right. That means 21 divided by critical X, right? Fair value per share 20. So this becomes 1.05. So this is the adjustment factor, and this is something we have already computed. So this is now not new to you. The only thing is we now need to understand that what's the use of this adjustment factor. Okay. So I'll clear this. Yeah. Gilbert has computed this. Great. Alright, so now we will move on to the computation of EPS, for which we need the weighted average number of shares. Now EPS for the year 2000x2, how do we compute this? We need weighted average number of shares. First, okay, I will call it as A and this becomes B. Now what is going to be the weighted average number of shares? So we have two cutoff now. We have two cutoff. This is a calendar year in the question, and the right issue came on 1st of March. So that means prior to right issue, we need to compute the number of shares. So prior to right issue, how many shares were there? 5 lakh. On which we will apply the adjustment factor into 1.05 into 2 divided by 12. Correct? Why are we doing this? We are doing this to compute the weighted average. Plus, so you can compute this and let me know, plus whatever is the number. After 1st of March, what is the number of shares? 6 lakhs. Now, do we need to give the adjustment factor? No. Because now this number already includes the right issue. So this remained for 10 months. So because of this, what did we get? We get 5,87,500 shares. This is nothing but B. Correct. So how do you get EPS? A divided by B. EPS is A divided by B. That is A divided by B. What do you get? 15 lakh divided by 587,500. 2.55. 2.55 is the EPS. Okay, 2.55 is the EPS. Now, we will not remain limited to the current year. We will also be required to recompute the EPS for the comparative year. And how do we do this? Very simple. In the last year, adjustment will be made for the shares. Amount remains intact. This is 11 lakh. Yeah. But the number of shares need to be adjusted. And because the last year was all of without right issue, so that's why this will be for 12 months. Yeah. So now, can you tell me what is going to be the amount? 5 lakh into 1.05. So we get 5 lakh 25,000. I'm not sure, Manish, which amount you have computed. So this is 5 lakh 25,000. And here again, what do? You will compute it A divided by B. 11 lakh divided by 5 lakh 25,000. Can you tell me what's the amount? Can you tell me what's the amount of EPS of the last year? Very good. So Sakshi and Gilbert are getting the same answers. I'm not sure why Manish is getting a different answer. Khushi also seems to be getting a different answer. Quickly, she has computed this one correctly. So this one now please. Here, A divided by B in this year. What is going to be the amount? What is going to be the amount of EPS? EPS is what I am looking at now. Now I am looking at EPS of the last year. Quickly, who can give me the EPS for the last year? Okay, great. So Kamal, Gilbert, Kushi, and Kulu, they have all computed, and this is 2.09. Okay, Kushi is saying 2.095. All right. 2.095. Yeah. So study says 2.0. Sorry, 10. You are saying 2.09. So whatever it is, right? It doesn't make much of a difference. So I'm just writing your answer. Okay. Yeah. So this was all about computation of EPS whenever right issue is involved. In the exam, please remember that whenever the question will require you to compute EPS, whether it's a case of bonus issue or it's a case of right issue, comparative years EPS, if the data for the comparative year is given, will be required to be computed by. You should not think that the question will ask you to compute for both the years. You need to do that on your own. Okay? Clear? All of you clear? Yeah? Great. So now we will move on to the next topic. Next topic means the next concept within EPS, which is called as diluted earning per share. If you want, you can refer to some of the points for your notes on this page of the study material. Yeah, page 1.101, which talks about diluted earning per share. Again, a very interesting concept and very simple question. The question will become very simple if the concept is understood clearly. Diluted EPS, or we can also say DPS. So far, all the discussions that we have had done in respect of EPS were all about basic earning per share. See, so far we did not discuss about EPS as to what type it is, whether it is basic or diluted. So that's why I'm just clarifying. If you want to note down, you can just make this cutoff. That all the discussions that we have had so far were all in relation to the basic EPS. Means the EPS that we had computed was called as basic earning per share. Other than basic earning per share, diluted earning per share means another type of EPS is also required to be computed in certain situations. And let's understand how is this required to be computed and how will this be different from basic EPS, because that's going to be the most important part for your understanding. For this, what I will do is, I will take you to the rationale. I will take you to the understanding as to why this is required to be computed. It's not about how this is computed or how is it different. We will also understand why this is required to be computed. The moment we'll understand why, automatically all the concepts around diluted earning per share will become clear to us. Okay. So say for example, net profit. See for example, net profit was 10,000. So net profit was 10,000. Okay. And what was the number of shares? 1,000. What will be the EPS? Can you all let me know what will be the EPS in this scenario? Quickly. Don't take time, huh? Quickly. What will be the EPS in this example which I have shown? You need to answer this quickly. Huh? What will be the EPS? Okay, great. So Kamal, Gilbert, Sushil, they are saying it should be rupees 10. Manish is saying 10. Very good. It will be 10. How do you compute this? Net profit divided by weighted average number of shares. Now, if you look at EPS, it indicates that the shareholder has earned rupees 10 per share during the year, because it's all about during the year earning. Yeah. Now, in this case, let's assume that the company has got convertible debentures. Amounting to rupees 20,000. Okay, this is the number of debentures which the company is having, on which interest is also paid. Let's suppose interest is 1,000. Yeah. So now, in this scenario, if you look at the debenture holders, they are getting a fixed return of rupees 1,000. And after paying off the debenture holders and after paying off everybody, shareholders are enjoying EPS of rupees 10 per share. Yeah. So this is the current scenario. This EPS, which we compute, is called as basic EPS. So I'll say this is what? Basic EPS. 10. Okay. Now, as per the terms which are attached to convertible debentures, they will get converted into equity after 2 years. After 2 years, what will happen? All of these debentures will get converted into equity. So now, what can be the impact? Let's understand. Now, today what we are doing is today itself. So say we are on 31st March 2020. So today itself, now we need to check that what will be the impact on the EPS if these debentures are converted into equity. Why? Because they have the potential to become equity shares as per the terms which are attached. Correct? So now, let's understand what we're doing. The profit will increase. Currently it is 10,000. The profit will jump to 11,000. I am removing the impact of tax for the time being. I am removing the amount of tax. Yeah. Ideally, this amount will increase by after tax return. So this 1,000 will not be given to the debenture holders, while those debenture holders will get the equity shares. So that's why this will get added to the kitty of the equity shareholders. So this will become 11,000. So the profit will increase. Correct? But at the same time, what will happen? The number of shares will also increase. But these debenture holders will also get the equity shares. Let's suppose as per the terms, again, please don't get into the computation. Let's suppose as per the terms, these debenture holders on conversion into equity will get 1,000 equity shares. So now what will be the revised number of equity shares? Revised number of equity shares will be 2,000. Now what are we checking? That let's suppose if the conversion of debentures into equity takes place, what will be its impact on profit attributable to equity shareholders, and what will be its impact on number of shares? Yeah. Now, with this revised understanding that we get, with this revised understanding that we have, what do you see? If this is the profit, this is the number of share, can you tell me what will be the EPS now? Now, under this scenario, say this is scenario 1. What is going to be the EPS? Quickly, if you can let me know the amount of EPS. Quickly, what is going to be the amount of EPS? Kamal is saying, sir, this will be 5.5. Manish has also computed this. Gilbert is asking, sir, when is this EPS calculated? I mean, before how many years? So you will not look into this criteria of before how many years. I'll get on to this point. Please wait. Kushi is also getting 5.5. Sushi is also getting 5.5. So this is 5.5. Now, after considering the impact of convertible debentures, what has been the impact on the EPS? EPS has gone down. EPS has gone down. Can you see this? EPS has gone down after considering the impact of convertible debentures. Whenever EPS goes down after considering the impact of convertible debentures, what are these convertible debentures? These are nothing but potential equity shares. What do you mean by potential equity shares? Those instruments which have the potential of becoming equity in future. Those instruments which have the potential of becoming equity in future. So now, after considering the impact of potential equity shares, if the EPS goes down, what do you call that EPS as? DPS. So can you see that by chance, what did we compute? DPS. We were not trying to compute it. We were just trying to understand the concept behind this. Why is this required to be computed? We were just trying to understand that today, every shareholder is enjoying an EPS of 10. But after the conversion, how will his EPS get impacted? So we could see there's a significant decline in his EPS after this conversion will take place, or because of the impact of potential equity shares. And that is nothing but is called as diluted earning per share. Dilution means going down. There's a dilution in the earning per share. Understood? Clear on this part? Yeah. Now the question which Gilbert has asked me, sir, how many years before we need to compute this? Whenever you will have potential equity shares, whenever it may be getting converted into equity or not in future, we are not worried about it. The moment you have potential equity shares, in that very year, you will have to compute the DPS. Because DPS is not the actual EPS. DPS is the dilution which we are checking, which will arise because of this conversion, which will take place or which may take place in future. Clear? Clear on this part? Yeah? Understood about DPS. Now, I'll take one more scenario. Say, if let's suppose this conversion happens, profit which gets added is 1000. So in this scenario, once again the profit becomes 11,000. Okay. But the terms are such that these debenture holders will get only 20 equity shares. Instead of 1000, what will they get? 20. So now this 1000 plus 20 will become 1020. So can you tell me what will be the EPS now? 11,000 divided by 1020. What will be the EPS now? $11,000 divided by 1020. Waiting for a response. What will be the EPS now? Okay, Sakshi and Kushi are saying 10.787. So now what do we see? This is becoming 10.78. Okay. Now we can see a trend which is different from scenario 1. In scenario 1, EPS was going down after considering the impact of potential equity shares. But in scenario 2, EPS is going up. Means this has increased after considering the impact of potential equity shares. So whenever there is a decrease, what do you call it as? It's a dilution. Therein, the potential equity shares are called as diluted in nature. These are potential equity shares, they are called as diluted in nature. But in this scenario number 2, what do you call them as? Anti-dilutive. This is anti-dilutive. Anti-dilutive means now there is no dilution, but it's increasing. Whenever there is potential equity share, which is anti-dilutive in nature, whenever there is potential equity share, which is anti-dilutive in nature, we do not consider them for computing DPS. What would it mean? It would mean that we will consider our basic EPS as equivalent to diluted earning per share. We will ignore these instruments. So whenever the question will ask us to compute DPS, but we can see the impact of potential equity share is anti-dilutive. So what do? You will say your basic EPS is also your DPS. So instead of 10, what will you do? You will say 10 is your diluted earning per share. These are ignored. Potential equity shares which are anti-dilutive in nature are ignored for the purposes of computing DPS. Okay, clear? Simple, easy and interesting or not? So this concept is very interesting if you understand this properly. Manish is asking, sir, it means if today potential equity shares become actual equity shares, then the company doesn't have much profits to give. Yes, that's correct. This is what it implies. Aditya is asking, sir, here diluted EPS can also be greater than normal EPS. Yes, which you have seen in scenario number 2. Narayanan is asking, sir, value of debentures is 20,000 and conversion we get 2,000. Total becomes 3,000. After conversion, please check it. No, after conversion, we are not saying they will get 2,000. I said they will get 20. But you can also consider this as one scenario. Yeah, and accordingly compute your answer. There can be any number of scenarios. This is only illustrative in nature for the purposes of your reference. Okay? Yeah? Now, we should move on to one illustration which needs to be solved by you only. Illustration 5 is your homework, and we will move on to illustration number 6. Please start reading this illustration number 6 and start solving this. page 1.14, illustration 6, and also note your homework on illustration 5. Okay. Net profit for the year X1, 12 lakh. Weighted average number of equity shares outstanding during this year, 5 lakh. Average fair value of one equity share during the year X1, 20. Weighted average number of shares under the option during the year X1, 1 lakh. Exercise price of shares under option during the year X1, 15. You are required to calculate basic earning per share and diluted earning per share. Please understand that when we have solved, okay, the diluted earning per share, we discussed about potential equity shares. Now, there is no list of potential equity shares which I can give. Potential equity share could be of various types. You can say convertible debentures, convertible bonds, warrants, options, convertible preference shares. There can be so many examples. It will all depend on the terms of the instrument whether they will become potential equity share or not. Correct? Now, similar to the one that we did, we also have one potential equity share over here in this illustration number 6. So can you all quickly compute this and let me know DPS, and you should also let me know what is your basic earning per share, because question requires you to compute both. Okay. Question requires you to compute both. Yes, I'm just hoping that you are computing this. Okay, Kushi and Sushil are finding the concept as interesting. That's great. Sakshi has computed basic EPS, it's 2.4. Priya is also getting 2.4 as the basic EPS. So we have net profit. What's the net profit? 12 lakh. Yeah. Then you are required to compute weighted average number of shares. This is also given in the question. 5 lakh. Correct. So weighted average number of shares, 5 lakh. So you can say this is A, this is B, this is 5 lakh. So what is your basic earning per share? A divided by B is. So we get 2.4. So this will get us 2.4. Yeah. So actually it's a tabular presentation which the study has done. So that's why I put the numbers like this. You only can research why you are doing this. But it's not necessary to follow the same format. You can compute it by whichever format you want to follow. Okay, then Krushi has computed the DPS also, 2.29. Priyanka has computed the basic earning per share. Manish has computed basic. Then Akshay has also computed basic. Gilbert has also computed DPS. Rangachula is getting DPS of 2.29. Kamal is getting 2.42. Okay, 2.4 and 2.28. Okay, great. Manish is getting 2.08. Okay, Nakul is getting basic earning per share 2.4. Sakshi has computed DPS 2.29. Fine. And I'm sure many more responses are on the way. So let's go to the solution also. Now in this case, if you'll see, there are options. What do you mean by option? Option means that the instrument can be converted into equity. So what's the number of shares under option? The number of shares under option is 1 lakh. Okay. Now option price. Option means you can say in a way the one who is holding the option. Option is an instrument. Okay. So the one who is holding that instrument will get the right to get the equity shares at rupees 15. But the fair value of equity share is rupees 20. Fair value of equity share is rupees 20. But this person is getting a right to convert his option into equity share at rupees 15 only. So that means here again there are two components. One component out of this 1 lakh is the one for which he is not required to pay any price. And the other one is at fair value. So if the number of shares which will be issued, so the number of shares that will be issued to him, at fair value is what? What is going to be that number? 1 lakh into 15 divided by 20. Which is nothing but 75%. So what will it become? 75,000. So these many number of shares will be issued to him at fair value. So he is paying the price for this and getting the shares. So for this, do you think there will be any dilution? No. There will not be any dilution. So why would the dilution arise? Dilution would arise because of the shares that will go out free of cost. So that's why the number of shares for the purposes of diluted earning per share should be 5,25,000. But after the option is converted into equity, will there be any impact on the earnings? No. In this scenario, the earnings remain unchanged. They remain unchanged. So this is A, this is B, this is A divided B. So in this case, what will happen? Definitely, if you look at the instrument, change in the earning is 0, but the number of shares issued is at least 1. So definitely this will lead to a decline in the EPS. So how does the EPS decline? It declines to 2.29. So therefore, this will become a case of diluted earning per share. I think all of you have solved this. Very good. Sana, Shabir have also solved this. Anushka has solved this. Very good. Yeah. So in this case, again, the EPS is the one which gets diluted. So that's why we can say this is basic one and this is diluted. Yeah, clear on this concept? Clear on the concept? Jamil is saying, sir, why and how that 75,000 is not clear. Jamil, this is because the option holder will get 1 lakh, right? But out of this 1 lakh, let's try to check what is it that goes free of cost and what is it that goes at fair value. So if you'll see, he is required to pay rupees 15 out of 20. So that means for the 75% shares, he is paying the fair value. So is it going to be any benefit? No. Any value which will lead to a dilution? No. Because what will lead to the dilution? Something which comes free of cost. Yeah. So the sum part which comes free of cost out of this 1 lakh is what? 25,000. That's the number which you will add for the purposes of your dilution. Similar to, if you remember, which we discussed in case of right issue also. Remember? Jamil, you're clear now? Jamil, clear on this? Yes or no? So with this, we come to an end to our discussion on basic earning per share. Now, if you have got any questions, any doubts, please let me know, because we'll be starting a new accounting standard now. Okay, Sushil has shared the computation. Great. Yes, before I move further on to the next accounting standard, please let me know if you have got any questions. AS24. Pranav, this is what I clarified, that out of the total shares, you need to check what is the component which is free of cost. Because the component which is free of cost will only lead to the dilution. The component which is coming at fair value will not have any impact on the earnings and will also not have any impact on the weighted average. Yes or no? Jamil is clear. Great. What about others? Any more questions in case you can? Gilbert is asking, sir, in anti-dilutive, we totally ignore or we mention it in the notes? See, for your purposes, you'll have to show the calculation in the exam, if at all it arises, and then you'll have to give a note. It's anti-dilutive, that's why it's been ignored, and that's why basic EPS and the DPS will become same. Okay. So she is asking, so diluted potential equity shares are what? So there is no concept of diluted potential equity shares. There is a concept of potential equity shares. Potential equity share means those equity shares which have the potential of becoming equity shares in future. That's it. Yeah. So that's the thing which you need to know. But I think you have currently mixed up diluted as well as potential, which is not correct. All right. Any more questions? Okay, Makul is clear. Kushi is also clear. Great. So now we are moving on to AS24, which is about discontinuing operation. It's a very small standard, very simple one. Discontinuing operation. Very small standard, very simple one. And I'm sure we'll be able to wrap it up very quickly. This standard only deals with the disclosure requirements. Means it has got nothing to do with recognition, measurement, or presentation. This standard deals with the disclosure requirements. Means the disclosures which are required to be given in the financial statements in case of a discontinuing operation. So let's now understand what do you mean by discontinuing operation. Before I get on to the definition, in very simple terms, you can say that whenever some part of the business of an entity is discontinued in the form means it's coming to an end or the plan is to sell it off, then it becomes a discontinuing operation. For example, an entity, let's suppose, has got 3 plants. Plant A, B and C. Plant C is not profitable, so that's why entity plans to sell it off. Plant C in such a situation will therefore become discontinuing operation. Clear? Clear on this? So let's go on to the definition of discontinuing operation. What do you mean? It's a component of an enterprise that the enterprise pursuant to a single plan is disposing of substantially in its entirety. You can refer this page now. Disposing of substantially in its entirety, such as by selling the component in a single transaction or through demerger or through spin-off of ownership of the component to the enterprise shareholders, or disposing of piecemeal, such as selling off the assets of the component or its liabilities, means they are settling its assets and liabilities by selling the assets, settling the liabilities, through which this component will automatically come to an end, or the plan is to terminate it. So the management plans to abandon that operation. Secondly, that operation should represent a separate major line of business or geographical line of operation. For example, say A Limited has got 3 plants in India, A, B, C. So they plan to sell it off. Now this should be a separate line of business. only then it will become discontinuing operation. Let's suppose another entity B Limited is carrying out operations at two places, India and let's suppose Dubai. Now they are planning to do away with the operations outside India. There again, the line of business which these companies have opted should be a significant one for that to be considered under this tender. And that operation should be the one which can be distinguished operationally as well as for financial reporting purposes. Distinguished means it should be possible for the management to identify assets related to each and every option, liabilities related to each and every operation. Means there should be separate books for that, similar to what you see in case of a branch. Yeah, you can say a branch is nothing but a line of business, and which is also having its own records. So it can be distinguished if required, at least from a financial reporting perspective. And operationally also you can always do this. Correct? Only and only when these three criteria are met. I am repeating. When the entity plans to dispose of. Second, operation is a separate major line of business. Third, operation is one which can be distinguished. Okay. In such a scenario, it will become discontinuing operation to be covered under this accounting standard. Now, we have not yet discussed what is required to be done when it will get covered under this accounting standard. Okay. Namrata is asking, what do you mean by spin-off? It is again a way of disposing of the business. Clear? Yeah? Okay, so now let's look at some examples of activities that do not necessarily satisfy criteria A, but that might do so in combination with other some circumstances. So there are few examples which we can see. Then move on to page number 1.117. Yeah. Gradual or evolutionary phasing out of a product line or a class of service. Discontinuing, even if relatively abruptly, several products within an ongoing line of business. Shifting of some production or marketing activities for a particular line of business from one location to another. Closing of a facility to achieve productivity improvements or other cost savings. An example in relation to consolidated financial statements of a discontinuing operation will be the one of a subsidiary which is planned to be sold off. Yeah. Now, as around the third criteria, wherein we say that the operation should be the one which can be distinguished operationally as well as for financial reporting purposes. Now, when do we say that it's the one which can be distinguished? If all the following conditions are met. What are those? Operating assets and liabilities of the component can be directly attributable to it. So you can say assets and liabilities of each operation can be identified. Its revenues can also be identified separately. And at least a majority of its operating expenses can be directly. major operating expenses. Now let's understand how will that be possible. Say a company is dealing into 3 products and the company is maintaining separate records for each of these 3 products. Why? Because for every product there is a separate plant. So every plant has its books. Okay. So in such a scenario, all these 3 divisions will become the one which can be distinguished if required. Okay. Clear? Now, moving further onto the disclosure event. Now, before I talk about this disclosure event, let's understand what's the requirement of the standard. Because you may be thinking, sir, we have been discussing so many things about discontinuing operation, about various criteria and all. But what's the objective? What does the standard require? In very simple terms, you can say, this standard requires that whenever an operation of an entity is discontinuing, means that qualifies for a discontinuing operation as per AS24, then it should be disclosed in the financial statements. A disclosure around such transaction which has not yet taken place. Why? Because the entity is only planning to sell. It's not yet sold off. Please remember, we are talking about something which is planning to be sold, planning to be disposed of. It's not yet disposed of. So the standard says that while the management is in the process of doing this, and if before this sale takes place or this disposal takes place, financial statements have to be drawn, then some disclosure around this event which has been going on needs to be included in the financial statements. Some disclosure around this event needs to be included in the financial statements. Okay, so that's the requirement of the standard. Yeah. Now, let's understand about initial disclosure event. Initial disclosure event is very important because only when we'll say that these criteria are met, then we will think about making a disclosure. So far, please remember, again, don't get confused. So far, all of the points that we had discussed were in relation to the discontinuing operation. Means whether an operation will be considered as discontinuing or not. Okay. And what all things are required for this. But now we are going to talk about situations or the event or the criteria which are necessary for the disclosure of this discontinuing operation. So now we are moving on to the next step. We are now checking the criteria, situations for its disclosure. Okay. With respect to discontinuing operation, the initial disclosure event is the occurrence of one of the following, whichever occurs earlier. So what's the event? Either the entity has entered into binding sale agreement for substantially all the assets of that discontinuing operation. So there is a binding sale agreement. Either there is a binding sale agreement or the board of directors of the entity in case of a company, has both approved a detailed formal plan for the discontinuance and also made an announcement of the plan, or there is board approval and communication. Board has not only approved this but has also announced this. Generally, both these criteria are met for the disclosure to be given. But you need to remember that if either of these events have taken place, then you will give the disclosure in the financial statements. So let's understand what can be a detailed or formal plan for discontinuance. Identification of major assets to be disposed of. Expected method of disposal. Period expected to be required for completion of disposal. Principal locations which will get impacted. Location, function, number of employees who will be compensated. Because the employees may have to be terminated. Estimated proceeds or salvage to be realized by the disposal. Yeah? Clear? Okay. Now, as you move further on this page, it says, for recognizing and measuring effects of the discontinuing operation, this standard does not provide any guidance. This standard only provides the guidance about presentation and disclosure. Recognition and measurement has not been dealt under this standard at all. So let's move on to the disclosure requirements. So what are the disclosure requirements? Now this is the one which you need to understand the standard. So you can say, what are those disclosures which will be given in the financial statements are the one which we are going to cover now. So for your purposes, I'll just put down the steps now, just to summarize our discussion. Step 1. We check whether an operation is discontinuing or not. Step 2. We checked whether the event has taken place so that the disclosure should be given. Whether initial disclosure event is there or not. Step number 3. If the operation is discontinuing, of course, we'll move on to initial disclosure event, and if the initial disclosure event is also there, what is the next step? To give the disclosure. To give disclosure. In the financial statements. Next step is to give the disclosure in the financial statements. Okay. Now, what are those disclosure requirements? Let's understand. Description of the discontinued operation. Description means which business, which business line, which plant is getting disposed of. Business or geographical segment in which it is reported as per AS18. If there is a disclosure of such segment as per segment reporting, we'll cover that slightly later, segment reporting. If that has been disclosed somewhere else, that needs to be disclosed. date and nature of initial disclosure event. Date and the nature. Nature means whether the board approval has taken place, binding sale agreement has taken place. Okay. Date or period in which discontinuing is expected to be computed. Means if you are planning to sell it, this will be completed within 1 year, within next 6 months. So some description you will give. Carrying amounts as of the balance sheet date of the total assets to be disposed of and liabilities. The total assets and the total liabilities of such operation. What is that amount? That should be disclosed. Amount of revenues, expenses which are involved in that operation, that should also be disclosed. Any profits, losses from that operation, that should also be disclosed. The cash flows which are attributable to that operation, that should also be disclosed. Yeah. So all of these disclosures you will give in the financial statements. Disclosures other than initial disclosures, no. All the disclosures should be presented in the notes to the financial statements except for the amounts pertaining to pre-tax profits or the losses of the discontinued operation and the income tax expense thereon, which should be shown on the face of the P&L. Let's understand, what do you mean by this? In fact, some of you who would have worked on the financial statements might have gone through the financial statements, they would be knowing about it. This is something which you very, very commonly see in the financial statements. P&L, we all understand how is this P&L drawn. So I'm talking about statement of P&L. So we have revenues, then expenses, then we get profit. Now, some of you who would have gone through the financial statements, or maybe you can just go through financial statements of any of the companies, you will see that P&L is generally divided into two parts. And you will be thinking, sir, how is it possible? How can this division be done? This is only a presentation. Let's understand. Let's suppose there's a company which has got two business lines. Okay. The company is currently continuing with those two business lines. Currently continuing with those two business lines. But the plan is to do away with business line number 2. That's the plan. And the plan is that this will get executed within next 1 year. And that qualifies for a discontinuing operation as per AS24. In such a scenario, what will the entity do? Entity will draw a separate P&L for that business line and the first business line. So whenever the entity does this, generally, this is what you will see. Profits or losses from continuing operations. So first of all, what will the entity do? Entity will disclose the profits or losses which are getting generated from the continuing operations. And then entity will give profits or losses from this continuing operation. From discontinuing operations. Here again, they will compute revenues, because even though the plan is to discontinue, sales may continue. Yeah. This may have sales, this may have expenses, ongoing expenses, generally the expenses will be there. And this will generally have losses, but at times this may also have profits. But generally you'll see this will have losses. Okay, so this will be A, this will be B, and what are your total profits? Total profit or total losses are what? A plus B. A plus B. Okay. Yeah. So this is what the presentation requires. So standard says in the P&L, the part which belongs to discontinuing operations should be presented separately like this. And this is what you commonly see in the financial statements. But you commonly see in the financial statements when the company will have discontinuing operations. So let's suppose if today you pick up any financial statements, but you don't see this, you will say, oh, what sir was saying, it's there, but it's not there. That could be because of the fact that the discontinuing operation is not there. Okay, clear? Yeah. So this is other than the disclosures that we have discussed. So this is about the presentation requirement. Yeah. Now, the disclosures are also required to be updated. So what we will do is, we will talk about the updation of all of these disclosures after a break, because I can understand we have stressed this session once again. So let's take a break now, and after the break, we will continue with the remaining part of this time. Yeah, we will continue with the time period wherein the discontinuing operation is going on, and wherein some of the disclosures attached to it are required to be updated. How do we do that? So that's what we'll discuss. Okay. In the meantime, if you have got any questions, any doubts, you can just put across your question. So let's take a break, and after the break, we will continue with our discussion. Fine. Welcome back. So we'll now continue with the discussion on this AS24. So we were talking about updating the disclosures. So at times, because this event will continue for some time, so that's why it may happen that the disclosure which is given in the financial statements is required to be updated. Updated means in the next year. So let's understand. So let's understand what do you mean by this. See, the disclosure event took place sometime over here, and in the financial year 2021, disclosure was given. Okay, but this event is not yet completed. Sale has not yet taken place. So this has been continuing. And at times it may happen that this has not even got completed in the next year. So in such a situation, at times, because of some changes in the events, the transaction, certain disclosures may have to be updated. So let's understand. An enterprise should include, for the period subsequent to the one in which initial disclosure event occurs, description of any significant changes in the amount or timing of cash flows relating to the assets to be disposed of, liabilities to be settled, if there is any, and the event which is causing such change. The disclosure should continue in the financial statements for the period up to and including the period in which discontinuance is completed. So let's suppose this has not been completed in the next year. So this will continue in this year and this will also be given in this year. But let's suppose if the event gets completed in this year, then this will not go on to the next year. It will also be given in the next year, and that's it. Yeah. If an enterprise withdraws or abandons the plan, means this event will no longer take place. At times this is also possible that initially management had a plan, but now that plan is dropped. In such a situation, the disclosure should be given that what was previously disclosed as a discontinuing operation is no longer discontinuing. The reason for the same as to why this change is taking place and its effect, means its impact on the financial statements should be disclosed. For every discontinuing operation, a separate disclosure should be given. If let's suppose entity has got 4 operations, 2 are planned to be sold off. So for 2, separate disclosure should be given. Comparative information for prior period that is presented in the financial statements prepared after initial disclosure event should be restated to segregate assets, liabilities, revenue, expenses, cash flows in a manner similar to that which is mentioned above. Okay, because when you will give the disclosure or the presentation particularly in the current year, let's suppose this is your current year. So for the comparative year, the numbers need to be presented. Yeah. Okay. Now some of the disclosures which are required to be given in interim financial reports. Any significant activity or event since the end of the most recent annual reporting period and any significant change in the timing or amount. So what does it mean? Say this is a listed company, but by chance what will now happen is for a listed company the accounting standards will not be applicable. So let's suppose this is a large company and which has also been doing interim financial reporting. Interim financial reporting means this has been preparing its financial statements say for a quarter. Q1. In the last year, a disclosure was given, and in the Q1 of 21-22, what do you need to do? Once again, that disclosure should be reassessed, and if there are any changes since the time it was disclosed in terms of the amount, in terms of the timing, or in terms of as to when it will get completed, all of those aspects should be disclosed. So you can say it's a kind of update which is required to be given. Clear? Yeah. So this is it that we had in this standard. As I told you, this standard is very simple and very small. So that's why it hasn't taken us much time to get done with this. Now, before I move further, let us quickly get on to your queries. If you have any queries as around this standard, let's discuss this. And then we'll also move on to the next standard. Okay, so we'll also be starting another standard. Yeah, but before discussing your queries. Poonam, I'll get this checked out. All of you, can you please confirm whether this monthly schedule of the sessions for August you have not been able to access? Because then I'll get in touch with the team and I'll just make sure that this is updated quickly. Manish is asking, okay, so Manish is saying, sir, actually I looked at the financial statements and I could see the bifurcation. Very good. See, when you look at the actual financial statements, you will get exactly the thing, what we have discussed as to how that will be presented in the financial statement. So Kamal is saying, no, sir, we have the schedule. So Kamal, can you please guide Poonam as to how the schedule can be accessed? Because I think Poonam has not been able to access that. And anyways, for the purposes of your reference, I told you, your classes will continue the same way. That means Monday, Wednesday, Friday, same way your courses will continue. Yes. Any more questions, any more doubts in case you have, please let me know. Then we'll move on to the next one. Okay. Sanjay has got the schedule. Sakshi has got the schedule. So I think there's a link which Kamal has shared. I'm not sure whether you are referring to that or not. I just put it on the board. It's live.ici.org. It's live.ici.org. BOS VCC. I think this is the link which you need to get onto. Yeah? Clear? because Kamal has been able to access this, then I'm sure everybody would be able to access this on this week. Thanks, Kamal, for this. So you're all clear on this accounting standard number 24. As we discussed, this standard was all about disclosures. There was nothing in terms of recognition or measurement. The only thing which it touches upon is the presentation of the P&L, which has to be separate on the face of the P&L, and which is generally the practices which you see companies present their statement of P&L into two parts: continuing operations and discontinuing operations. Yeah, clear? In the exam, in this standard, basically you need to just remember three things. Discontinuing operation means what's the criteria around it. Initial disclosure event means once again what's the criteria when you will say yes, the initial disclosure event is triggered. And third, of course, is the disclosures which are attached. Which is very simple. Disclosure will mean you will just explain the transaction which is going to take place with the numbers and all, everything. Okay, clear? What I was saying, I have already checked it, sir. And still, if you have not been able to access this, then I think the only way is I'll just reach out to the team and I'll just ask them to recheck as to what's been the problem, why you have not been able to access, or maybe if any of you have not been able to access this. Alright. So now moving further on to AS18, which talks about related parties. Related party disclosures. Once again, this standard only talks about disclosures. Means here again, we will not be talking about recognition, measurement, and also not the presentation. It's only the disclosures which are covered under this standard. Means whenever there is any transaction with a related party, and if there is any outstanding balance in respect of a related party, some disclosures are required to be given which are prescribed by this standard. Okay. And before I move on to the various concepts which we need to cover in this standard, let us just quickly understand about the related party. In very simple terms, we can say a related party is a party which is able to influence us or get influenced by us. I'm just talking about a very, very simple language for the time. Now, because of this relationship, what can be the impact or what can be the problems in the financial statements? Let's try to understand that. One, it may happen that there are two parties. Who are those parties? Say A limited and B limited. So I'm not talking about father, son, father, mother. I'm talking about two companies who are related to each other. Now, how will they become related to each other? We'll talk about it. Let's suppose if they are related to each other. Now, there's a possibility that if they are related to each other, say for example, they belong to the same group, then the transactions which will take place between them may not be at arm's length. Arm's length price means it's below market price. This is a possibility. Yes or no? It may or may not happen. So we are not saying that every time a related party is involved, the transaction will be below arm's length. No, I'm not saying this. I'm saying there is a possibility. That's why whenever there is a related party involved, the requirements become stringent. And this area of dealing with related parties, area related to related party transactions, related party balances, is not only covered under accounting standard. If you look at various acts today, almost every act has been dealing with this area. If you talk about Companies Act, there is a specific provision in relation to related parties over. If you talk about income tax, there are specific provisions in relation to related parties in the form of associated enterprises. Under accounting standard, you see we have a separate detailed accounting standard which is dealing with the related parties. Auditing standard, under auditing standard also you see there's a separate standard which deals with the related parties. So you can now understand the importance of this area. This area, or you can say this disclosure, is considered to be very, very important in the financial statements. This is one of the most important disclosures in the financial statements. Okay. And that's why practically, I'm not talking about the examination perspective. Definitely for examination this is important, but practically whenever you will be working on the financial statements or you will be referring to the financial statements, one of the most important item in the financial statements happens to be the disclosures related to related parties. Clear? Yeah? And this is only because of the fact that the transactions with the related parties may take place at below arm's length. We're not sure. Now, let's try to understand whether this standard deals with this problem. So every time we are saying that there's a possibility that the transaction is taking place below arm's length price. There's a possibility. Now, does it mean that the standard AS18 prescribes the rate at which the transaction will take place with the related parties? The answer is no. Why? Because this standard doesn't deal with measurement at all. This standard doesn't deal with recognition at all. What does this standard say? This standard simply says that whether the transaction has taken place at arm's length or not, irrespective of what has been done, all the transactions with the related parties should be disclosed in the financial statements. Why? Because it's important for the users of the financial statements to know as to how many transactions, the volume of the transactions which the entity would have carried out during the year with its related parties. It becomes important for the users of the financial statements to know about it. So that's why this is required to be disclosed. But nowhere this standard talks about any of this pricing. Okay. This standard will not talk about this pricing at all. Clear? Clear on this? Yeah? Okay, so now we should first of all understand what do we mean by related parties. Yeah. What do you mean by related parties? So for this, we need to go to page number 1.64 of the study material. Because there are 5 categories which have been considered as related parties by this thinker. So we are talking about related parties. Related parties, or you can say related party relationships. So what are those related party relationships which will get covered under AS18? First, enterprises that directly or indirectly through one or more subsidiaries or intermediaries control or are controlled by or are under the common control with the reporting entity. Now, in this standard, you will see that things, if those are read in the plain language, are very difficult to understand. Yeah, so that's why what we will do is we'll just try to create sort of situations, okay, basis which we will try to understand all of these definitions or all of these relationships. So first, it says enterprises that directly or indirectly through one or more intermediaries control. So let's suppose A has got 100% shares of B. B has got 80% shares of C. Yeah. Now let's apply this criteria. Enterprises which directly through one or more intermediaries control. Now in this case, A and B are holding and subsidiary. B is a subsidiary, A is the holding. Correct? Therefore, A and B will become related parties. A and B will become related parties. It's a direct control. A has got direct control over B. Let's see another situation. B has got control over C. So therefore, B and C will also be related parties. B and C will also be related parties, means B will be related to C, C will be related to B. Okay. So we can see A and B are related to each other. B and C are related to each other. Why? Because one of them has got control over the other, and which is also called as holding or subsidiary relationship. I'm sure you would be knowing about it. Now, if we see A has got control over B, what does the control mean? Control means that A has got the power to control the composition of board of directors. Means today, as regards the decision making of B, who will have the power to give the directions? It's A. Why? Because 100% shares of B are held by whom? A. For C, it's again the same case. Why? Because majority of the shares of C are held by whom? It's B. Correct? It's B. Now, because A has got control over B and B has got control over C. So therefore, in a way, we can say A has got indirect control over C. A doesn't have direct control, but through B, who is B? Intermediary. B is an intermediary in this case. Through B, through an intermediary, A is able to exercise control over C. So that's why in this scenario, what will happen? A and C will also become related to each other. A and C will also become related to each other. Okay. They will also become related to each other, and we say it's a situation of indirect control. Now, in this case, B will be a subsidiary of A and C will be a subsidiary of B. Or in other words, we can say B is holding of C and A is ultimate holding of C. B is what? Holding of C. And for C, who is the ultimate holding company? A. Now for B, can you tell me who is the holding company and the ultimate holding company? Both of them. For C, we understand B is the holding and A is ultimate holding. So for B, can you tell me who is the holding and who is the ultimate holding company? Quickly, over to you. So for B, who is the holding company and who is the ultimate holding company? Both you need to tell me. For B, who is the holding company and who is the ultimate holding company? Yes. Now I'm waiting for a response. Quickly. For B, who is the holding and who is the ultimate holding company? Okay, great. Kushi and Manish are saying A. Gilbert is saying, sir, for B, A is the holding as well as the ultimate holding company. That's absolutely correct. For B, it's only one entity who is sitting above B, and that happens to be its holding as well as ultimate holding company. Clear? Clear on this? Yeah. So this is the first type of related party relationship. Now, because you always look for the notes, so that's why I would suggest what you can do is, we have got only 5 points for the related party relationships, which are given on this page in the study material. These are not too big for you to understand. So what you can do is, maybe these pictorial examples you will note down, or you can take a click of this, yeah, whichever way you find appropriate. This will help you during the course of the revision. Okay. Then I think Sakshi, Rangajula, they are saying it's the same. Rishya, Priyanka, Shabir, Sushil, very good. So now moving on to the second part of the second relationship. B. Under B, it says, let's suppose A and B have formed a joint venture. They have formed a JV. JV means joint venture. So what does it mean? A and B have come together. They have created an entity. They have created a separate entity in which both of them have equal control. Now, in this entity, we are not saying control is that of A or B. We are saying control is exercised by both of them equally. Or in simple terms, we can say both of them have got joint control over C. In such a scenario, A and C will be considered as related to each other. B and C will also be considered as related to each other. B and C will also be considered as related to each other. But please remember, A and B will not be considered as related to each other. Why? Because A has got joint control over C, B has got joint control over C, but as regards A and B, they don't have anything amongst each other. Who are they? They are two investors who have invested in a company. Say both of them have invested 50% each. And it's not necessary that they invest 50% each. It may happen that A is investing 60%, B is investing 40%. Yeah, that situation is also possible. Okay? But for your purposes, you should keep it 50-50 because at your level, for a joint venture, it should be equal ownership. Clear? Yeah. Further on to the same point, it says, let's suppose there is a company D. Which holds, say, 23% equity shares of E. Please remember that for control, you will understand this in more detail when we will be covering AS21 or say consolidation, consolidated financial statements. But for the time being, we will just simply say that if the shareholding in an entity is more than 50%, then the control is considered to be there. Control is the one which we discussed in point number A. Now in point number B, another point which you can remember is for joint venture, it has to be equal stake. And in case an entity has got less than 51%, but more than 20%, then it is considered as if such an entity has got significant influence over entity E. So it has got significant influence over entity E. The moment we say that D has got significant influence over entity E, in such a scenario, E will be considered to be associate. In such a scenario, E will be considered to be associate of D. Associate, you can say, is the one over which the investor D exercises significant influence. Now, you may be thinking, so what's the difference between this control which we discussed and significant influence? See, in case of a control, what will happen? Investor will have the power to take the decisions. He will be driving the decision making. But in case of significant influence, investor will not have the power to change the decisions or drive the decisions. He will not have the power to direct. He will be only having the power to participate in the decision making. Means when the decision making is going on, he can participate, but he cannot direct that. So that's the difference between control and the significant influence. So the moment we have significant influence, then D and E will also become related parties. Clear? Yeah? Clear on this? Okay. Moving on to the next situation, number C. I think I've got some queries from you. Not the queries. Yeah, these are the responses. Okay, great. Third, C. Individuals owning directly or indirectly an interest in the voting power of the entity that gives them control or significant influence over the entity and the relatives of such individual. See, point number A and B, everywhere when we were talking about control, significant influence, joint control, we were discussing about the entities. So A, B, C, D, E, they were all companies. Now we are talking about individuals. So individual means, for example, we have Anushka. Yeah. Yes, we have Anushka. So now we are saying Anushka as an individual, not as a company, has got control over an entity. Which entity? Say A Limited. So in this scenario, Anushka and A Limited will become related parties. Say Anushka has got significant influence over B Limited. Anushka has got significant influence over B Limited. So Anushka and A will become a related party. Anushka and B Limited will become the related party. Please understand that this is only an individual. And this can again be directly or indirectly. Means there can be another individual entity. And any relatives of Anushka, the relatives means those relatives which have been defined under AS18, will also be considered to be related parties of A and B. Now, who are the relatives? Relatives of Anushka. They will also be considered to be related parties of A Limited and B. Clear? Yeah? Moving on to the next point, D. KMP and relatives of such personnel. KMP plus their relatives. Now, who can be a KMP? KMP has been defined under this standard. So, we need to understand the definition of KMP first of all. KMP means the person who has got the authority as well as responsibility. So, this person has got authority plus responsibility. So this person has got both authority as well as responsibility in relation to planning, directing, controlling the activities of an entity. In relation to planning, controlling, directing. What? Say if we are looking at the relationship between KMP and another entity A Limited. So the activities of A Limited. If let's suppose any person has got authority as well as responsibility to plan, to control, direct what activities of A, then such a person will be considered to be KMP as per AS18. Okay, such a person will be considered to be KMP as per AS18, and such a person, along with relatives of such a person, will be considered to be related party of A. Now, who can be a KMP? Basis this criteria. Let's look at some examples. If you look at the board of directors of a company, do you think they play this role? Yes. If you look at the managing director, if you look at the CEO of the company, you will generally find them that they play this role. They have the authority as well as the responsibility to plan, control, direct activities of an entity. Okay, clear? Next, point number E. Point number E can be a bit tricky, so that's why I need your attention. I can understand we are approaching towards the end of the session, but this is a bit tricky, so that's why I need your attention. And it won't take much time, so don't worry. Enterprises over which any person described in C or D. Who was C? Individuals plus relatives. Individuals plus relatives. Remember example of Anushka? Yeah. Or D means or KMP plus relatives. Enterprises over which either this or this is able to exercise significant influence. Those enterprises will be considered to be related parties of this or this. This includes entities owned by the directors or major shareholders of the reporting entity and enterprises that have a member of KMP in common with the reporting entities. Yeah, so this is only an example as an obvious which has been given. Now Sanjay has a query. Sanjay is saying, sir, in point number D, can we say that the company secretary and CFO are not KMP as per the definition given in AS18? See, I can understand your query is coming from the requirements of the Companies Act, which specifically says that CFO and company secretary are the KMP. But please understand, Companies Act and accounting standards are two different things. So because CFO and company secretary is a KMP as per Companies Act, that doesn't mean that they will also become KMP as per AS18 necessarily. You need to evaluate them. Only if they become KMP as per the criteria of KMP as per AS18, then you will say them as KMP, otherwise not. Okay, yeah. So with this, we come to an end to our discussion for today. So please remember that we have discussed 5 relationships. We can say 5 categories. And this entire standard is based on these 5 terms. So in the next session, we will continue with our discussion. Hopefully, we'll also be starting a new topic, new standard in the next session. But it's very, very important that you come after revision of all of these 5 points. Because if you don't remember these points, then let me assure you that you will not be able to appreciate any of the concept of this standard in the next session. Yeah? So that's why it's very, very important that you revise before we meet in the next session. Okay? Yeah? Clear? So with this, we can end our discussion over here. Sushil is asking, sir, full form. Sushil, I would suggest you to refer to the study material, please. Yeah, because I think you miss out on the full forms many a times. So it shouldn't really impact you at the time of your revisions. For the time being, you can note down what is KMP, key managerial personnel, key management personnel. Okay. Clear? Alright, so with this we can end our discussion over here. And your homework, please remember, is to revise all these 5 points. Yeah? So thanks to all of you once again for your time today and for your participation today. And let's meet in the next session. Thanks so much.